Today, we're talking about one of the most fascinating events in all of crypto. It's something that's literally hardwired into Bitcoin's code, an event that has, in the past, sent absolute shockwaves through the market. I'm talking about the Bitcoin halving. So, what is it, and why does it matter so much? Let's get into it.
But first, just think about this for a second. What if a currency wasn't controlled by a government or a central bank? What if its entire economic policy was just written into its code, set in stone, and couldn't be changed by anyone? Well, that's the whole revolutionary idea behind Bitcoin, and it is the absolute key to understanding the halving.
All right, so here's how we're going to break this all down. First, we'll talk about Bitcoin's code of scarcity. Then we'll get into the halving mechanism itself. After that, we'll look at the ripple effect it has on price and miners. We'll also touch on the whole correlation versus causation debate. And finally, we'll look ahead to the future. Sound good? Let's jump in.
Okay, first things first. We have to talk about what makes Bitcoin so different from, well, pretty much any other form of money we've ever had. And it all comes down to its built-in scarcity. You've probably heard people call it digital gold, and there's a really good reason for that.
This right here, this number is everything. 21 million. That's it. That is the maximum number of Bitcoin that will ever exist, period. Unlike dollars or euros, which can be printed whenever a government decides to, Bitcoin has a hard, finite cap. This is the absolute bedrock of its entire value proposition.
And you can see the genius of this right from the very beginning. This is a quote from Bitcoin's mysterious creator, Satoshi Nakamoto. The idea was simple but powerful. Make the creation of new Bitcoin require actual work, just like mining for gold. You have to expend real resources and energy to get it.
And all of this makes Bitcoin what economists call a deflationary asset. You know how the cash in your wallet tends to buy a little less each year because of inflation? Well, Bitcoin is designed to do the opposite, because no one can just fire up a printing press and make more of it. The idea is that its value should, at the very least, hold steady or even increase over time.
So the big question is, how does Bitcoin actually enforce this scarcity? How does it make sure we never go over that 21 million cap? Well, that's where the straw of our show comes in, the halving. It's this automatic, pre-programmed supply shock that's baked right into the system.
So here it is in a nutshell. About every 4 years, or more precisely, every 210,000 blocks of transactions, the reward that miners get for creating new Bitcoin is suddenly, automatically, sliced right in half. It's a built-in economic slowdown that's as predictable as the sunrise.
And you can see it happening right here. I mean, look at this. Back in the early days, miners got a whopping 50 Bitcoin for every block they mined. Then in 2012, poof, it dropped to 25. Then 12.5, then 6.25. And in 2024, it dropped again to just over 3. It's this beautiful, predictable march towards zero new supply.
Here are the actual dates for the last few halvings. You can pretty much set your calendar by them. And it's this absolute predictability that makes the halving such a massive, highly anticipated event for everyone in the crypto world.
Okay, so a piece of code automatically cuts the new supply. Basic economics 101, right? If demand for something stays the same, or even better, goes up, while the new supply gets squeezed, what usually happens to the price? It goes up. But what does this actually look like in the real world for Bitcoin's price and for the people securing the network?
And this is why everybody gets so excited. Just look at these numbers. The pattern is pretty undeniable. In the months following every single past halving, the price of Bitcoin has seen some absolutely massive gains. It's a powerful historical trend that is, frankly, very hard to ignore.
This quote from a Reddit user really nails the feeling in the market. You know that old saying, "This time is different," is usually famous last words in finance. But you have to admit, things have changed. A few years ago, Bitcoin was just a weird niche thing. Now, you've got Wall Street giants and huge institutional players getting involved. The whole game is different now.
But let's not forget the miners. For the people and companies actually running the computers that secure the network, the halving isn't a party. It's a brutal, overnight 50% pay cut. This kicks off a massive struggle for survival, where only the most efficient, lowest-cost operations can stay profitable. It's basically survival of the fittest.
So, with that history, is a big price rally after the halving basically a sure thing? The data looks really compelling, yeah. But we have to be smart about this. Just because two things have happened together in the past doesn't automatically mean one causes the other.
Okay, so let's talk about the stock-to-flow model.
This thing was huge for a while. It was this theory that tried to predict Bitcoin's price based only on its scarcity on the halving cycle. And for a while, it seemed like magic. It tracked the price almost perfectly. And then, well, in late 2021, the model completely broke down.
So what went wrong? It's actually a pretty classic mistake. The model only looked at one side of the economic equation, supply. But price isn't just about supply, is it? It's about demand too. And Bitcoin's demand is influenced by everything from macroeconomic conditions to new things like ETFs, to regulatory news. It's anything but simple or predictable.
And I think Vitalik Buterin, the co-founder of Ethereum, just put it perfectly here. Any model that gives you this false sense of certainty that convinces you the price can only go up is not just wrong, it's dangerous. The market is a wild, unpredictable thing, and we need to remember that.
So where does that leave us? We know for a fact the halving is going to keep happening like clockwork. But the world around Bitcoin is changing faster than ever. So what does the future hold? What's different this time?
Well, there are definitely some real risks to keep an eye on. All this hype can lead to extreme price volatility. The pressure on miners could push smaller players out, leading to more centralization. And then there's always the risk that the reward gets so low, there's less incentive to secure the network. Not to mention just good old-fashioned market hype creating a bubble.
But there is a new, massive player at the table this time around, Wall Street. With the launch of Bitcoin ETFs, we're seeing a flood of institutional money pouring in, creating this huge, constant demand. And all of that new demand is chasing a new supply that's just been cut in half. You could call it a compounding supply shock. It's a completely new dynamic.
And that leaves us with the big, tantalizing question. The code is predictable. We know exactly when the next halving will happen. But human markets, they are anything but. With all these powerful new forces shaping demand, will the next cycle just be a repeat of the past? Or is this time, finally, truly different? That is the billion or maybe even trillion-dollar question.